The Bank of Japan has unleashed the world's most intense burst of monetary stimulus on Thursday. The BOJ is promising to inject about $1.4 trillion into the economy in less than 2 years. Now, this radical gamble has sent the yen reeling and bond yields to record lows. The new governor as well has committed the BOJ to open-ended asset buying. He said that the monetary base would nearly double to $2.9 trillion by the end of 2014.
Bank of Japan, and that is fueling price action and momentum in Japanese stocks, especially Japanese exporters. So let's discuss that story with Shane Oliver, Head of Strategy and Chief Economist with AMP Capital, who joins us live from Australia. Shane, good morning. Thank you for joining us. Shane, in the region, clearly BOJ is the big story.
It certainly is. There was a bit of fear yesterday that the Bank of Japan may not deliver, but it's delivered a lot more than had been expected. So consequently, that's dominating investment markets in the region and having an impact globally. Japan has been effectively in a long slumber for the last 2 decades, and it finally seems to be waking up, and that's fairly significant given that it's still the world's third largest economy.
Shane, hi, morning. Given the kind of outperformance that we've seen from the U.S. equities in the last 3 months, now them, scratching record highs as well, do you think risks of a risk-off are sort of more prominent now because investors would be wanting to take chips off the table?
Well, it's an interesting debate. We have had strong gains in markets through last year, and then, of course, the first few months of this year. But, of course, it hasn't been uniform. The emerging world has been quite a lot weaker, and more recently, Europe has been a bit volatile as well. And, of course, the US market has managed to keep going higher, and now, of course, Japan has broken higher again as well. So I think it's a bit of a mixed bag at the moment. My feeling is that we could go through a bit of a corrective period in markets over the next month or so. But ultimately, I think this year will be a positive year for share markets, and that any corrections we do see in equity markets should be seen as buying opportunities. I certainly don't see a return to the sort of Eurozone-driven worries that we've seen over the last few years.
Shane, historically, if I map how risk-on rallies have moved, they've always benefited emerging markets. But if I map this year's pattern or this year's risk-on rally, money is moving out of emerging markets and money is moving into developed markets. Now, why is that happening?
Well, that's an interesting question, and you're right. But historically, whenever we've seen risk-on, it's benefited the emerging markets. And, of course, we saw that initially as we went through last year. Emerging markets did have a good rally out of the lows from around the middle of the year. I suspect that this time there's several things going on. One is that China has been a big part of the emerging market story, and it's not as strong as has been the case in the past. It's growing at 7.5–8%, which is still good, but it's not the 10% that investors have become used to. Secondly, Brazil and India both have particular issues. Inflation's ticking up again in Brazil. It's a bit of a constraint in India that's limiting the extent to which the Indian central bank can cut interest rates, and economic growth has been disappointing in India as well. So that's acting as a bit of a drag. I suspect that, and then on the flip side, of course, the US story has become a bit more positive than at any time over the last few years, with the housing recovery coming through, manufacturing looking healthier, and the energy boom in the US, the shale oil boom. And so I think all of those things are combining to lead to a somewhat more favourable outcome for some developed countries. Japan, the situation in Japan's also improved, whereas the emerging world sort of not looking as bright as it might have in the past. And that's led to this sort of different reaction to what we normally see.
Shane, you just talked about India as well, and we've been seeing relentless FII selling in the last few, trading sessions. The month has gotten off to a pretty bad start as well. Do you think the mood is now sort of sour towards India purely because of the points that you just talked about?
Unfortunately, it probably has. I would have thought that by now sentiment might have returned to India. Unfortunately, the fundamentals haven't really supported me. The inflation numbers have been a little bit sticky. The growth numbers have surprised on the downside. And I think the basic problem has been a lack of reform on the part of the Indian government. All of those things have soured sentiment to some degree. I suspect that if advanced, say, markets in the US and Europe sort of continue to power ahead, then some money will find its way into emerging world and India, but it may be a while before it gets back to outperformance again. The other thing, I guess, which is a bit of a constraint on the Indian share market, is that even though the valuations have improved dramatically, it's still not a cheap market in the emerging world. You can still find cheaper markets. Even the Chinese share market is a cheaper share market than the Indian share market.
Right, Shane. Really appreciate your time, and thank you for your insights.